Because here's the uncomfortable truth. The next generation of wealth in America will not be built by people who think like their parents did. It will be built by people who think ahead, who see opportunities before they become obvious, and who position themselves for the future instead of reacting to it. That way of thinking has a name. It's called visionary wealth thinking. And today, I'm going to show you exactly what that means, why it matters now more than ever, and how you can start applying it no matter your income level or background. The truth is uncomfortable, but powerful. Wealth is not first created in your bank account, it's created in your mind. And the people who win financially in the next decade won't just be the hardest workers, they'll be the most visionary thinkers. Visionary wealth thinking is the ability to see beyond immediate income, short-term market noise, and emotional financial decisions. It's about understanding where the world is going, positioning yourself ahead of trends, and building systems that grow even when you're not actively working. In the United States, we are at a major financial crossroads. Inflation has changed spending habits. Technology is disrupting careers. Traditional retirement paths are no longer guaranteed, and yet this environment is also creating historic opportunities for those who think long-term. Not how much do I make this month, but how do I build assets that pay me for decades? Not is this risky, but what is the calculated risk of not adapting? Not what worked in the past, but what will matter in the future? And to deepen this way of thinking, it's important to understand that visionary wealth is built by stacking small intelligent decisions over long periods of time, not by waiting for one lucky break or viral moment, because most overnight successes are simply decades of preparation hidden behind a single visible outcome. And when you look closely at financially successful individuals in the United States, you'll notice a common pattern. They began by mastering fundamentals, they delayed gratification when others rushed for comfort, and they consistently reinvested profits instead of upgrading lifestyles too quickly, which is especially relevant today as social media creates pressure to appear successful rather than actually become successful, because visionary thinkers are willing to look ordinary now to become extraordinary later. And they understand that wealth creation is less about impressing others and more about controlling optionality, meaning the ability to make choices without financial stress, whether that's choosing how to spend time, which projects to pursue, or when to walk away from bad opportunities. And this level of control comes from liquidity, diversified income streams, and assets that are resilient across economic cycles, which is why visionary thinkers study history just as much as they study the future, recognizing that while technology changes, human behavior remains remarkably consistent, with fear and greed driving most market movements. And those who can manage their emotions gain an edge that no algorithm can replicate, especially during uncertain periods when headlines scream crisis and panic becomes contagious. Because visionary thinkers know that uncertainty is not an enemy of wealth, but a prerequisite for it, since without uncertainty there would be no risk premium, no undervalued assets, and no asymmetric opportunities. And this mindset allows them to stay invested in progress even when confidence is low, which is critical as the U.S. economy continues transitioning toward a knowledge-based, digitally leveraged system where adaptability matters more than credentials, and where financial education is increasingly self-directed rather than institutionally provided, meaning those who take responsibility for learning about markets, taxes, capital allocation, and business fundamentals gain an advantage over those who outsource thinking entirely. And this self-education doesn't require perfection or advanced math, but rather consistency, curiosity, and the willingness to question assumptions that may no longer apply, such as the belief that safety comes from a single employer or that diversification means only owning traditional assets, because visionary wealth thinkers diversify not just investments but skills, networks, and income sources, knowing that resilience comes from flexibility, and flexibility comes from preparation, which is why they prioritize liquidity and optionality, even when returns temporarily look lower, understanding that cash is not trash when it gives you the power to act decisively during dislocations. And speaking of action, visionary thinkers also understand the difference between motion and progress, avoiding the trap of constant activity without measurable results, instead focusing on leverage points where effort produces outsized outcomes, whether that's investing in systems, delegating low-value tasks, or using technology to scale impact. And this applies not only to business, but to personal finance as well, where automating good behavior often matters more than making perfect decisions, because consistency beats intensity over time, and when mistakes inevitably happen, as they always do, the visionary response is analysis rather than self-judgment, asking what the data reveals and how systems can be improved to reduce future risk, which creates a feedback loop of continuous improvement rather than emotional burnout. And over time, this compounds into confidence, not the fragile confidence based on recent wins, but durable confidence grounded in process and preparation, which is especially valuable in an era where economic narratives shift rapidly and certainty is often an illusion. And this is why visionary wealth thinkers place such a strong emphasis on principles over predictions, knowing that no one can consistently forecast markets, interest rates, or technological breakthroughs. But principles like diversification, margin of safety, long-term alignment, and disciplined execution remain reliable anchors, allowing them to move forward even when the future is unclear. And as wealth grows, visionary thinkers also recognize that money is a tool, not an identity, and that unhealthy relationships with money, whether fear-based or ego-driven, can sabotage even the best strategies, so they actively work to maintain perspective, using wealth to enhance life rather than replace meaning, which in turn supports better decision making because desperation and excess both distort judgment, and this balanced approach becomes increasingly important as financial success brings more complexity, responsibility, and visibility, especially in a society where financial outcomes are often moralized or misunderstood. And through all of this, visionary wealth thinking remains grounded in one core truth: the future rewards those who prepare for it before it arrives, those who think in systems rather than events, and those who understand that wealth is not a destination, but a dynamic process of learning, adapting, and aligning resources with long-term vision, which is why the most powerful investment you can make is not just in markets or businesses, but in your ability to think clearly, stay disciplined, and act decisively over time, because when your thinking evolves, your financial reality eventually follows. And as this mindset matures, visionary wealth thinkers begin to recognize that time is the most undervalued currency in modern society, far more scarce than money itself, which is why they structure their financial lives to buy back time rather than merely accumulate possessions, understanding that freedom is measured not by net worth alone, but by control over one's schedule, energy, and attention. And this perspective reshapes everyday decisions, from how they negotiate compensation to how they evaluate opportunities, because instead of asking, "How much does this pay?" they increasingly ask, "What does this cost me in time, focus, and long-term positioning?" And this becomes especially relevant in the US economy, where burnout is common and productivity is often confused with business. Yet visionary thinkers know that exhaustion is not a badge of honor, but a signal of poor leverage, prompting them to redesign workflows, invest in tools, and sometimes accept slower short-term growth in exchange for sustainable momentum. And this patience pays off as it allows clearer thinking, better judgment, and the ability to see opportunities that frantic minds miss, particularly during transitional periods when industries evolve and new models replace old ones. Because transitions are where wealth quietly shifts hands, often unnoticed by the majority until it's too late, and those with visionary thinking prepare during calm periods for opportunities that appear during chaos, which is why they build financial buffers not out of fear, but out of strategy, knowing that optionality is greatest when others are constrained. And this also explains why visionary thinkers pay close attention to incentives, both their own and those embedded within systems, recognizing that behavior follows incentives more reliably than intentions, so they design environments that make good decisions easier and bad decisions harder, whether through automatic investing, accountability structures, or aligning personal goals with professional incentives. And over time, this alignment reduces friction and increases follow-through, which is one of the most underrated advantages in wealth building, because many people know what to do but fail to do it consistently, whereas visionary thinkers prioritize execution over perfection, understanding that imperfect action compounded beats flawless plans that never leave paper. And this bias toward execution also applies to learning, where instead of endlessly consuming financial content, they selectively apply ideas, test assumptions, and refine approaches based on real-world feedback, transforming knowledge into wisdom through experience. And this experiential learning becomes a competitive advantage in a world where information is abundant, but insight is rare, especially as algorithms amplify noise and extremes, making it harder for average individuals to distinguish signal from distraction, which is why visionary thinkers intentionally curate their information diet, limiting exposure to fear-driven headlines and sensational predictions, while focusing on primary drivers like cash flow, balance sheets, demographic shifts, and technological adoption curves, because clarity is a form of wealth in itself, enabling faster and more confident decisions, and this clarity extends to values as well. Since visionary thinkers understand that wealth without direction often leads to dissatisfaction, so they define what enough means on their own terms, rather than outsourcing that definition to society, peers, or social media, which protects them from endless comparison and lifestyle inflation, allowing wealth to compound quietly rather than leak away through unconscious spending. And this self-definition becomes increasingly important as income rises, because higher income doesn't automatically create financial security if expenses scale at the same pace, a trap many high earners in the US fall into, whereas visionary thinkers treat income growth as an opportunity to increase investment rate, not consumption rate, accelerating the path to independence. And as independence grows, so does strategic generosity, because visionary wealth thinking ultimately expands beyond accumulation into contribution, recognizing that money can be a force multiplier for impact when deployed intentionally, whether through mentorship, investment in others, or supporting causes aligned with long-term societal progress. And this outward focus often reinforces wealth, rather than diminishing it, as strong networks, trust, and reputation become intangible assets that open doors inaccessible through money alone, particularly in business and investment ecosystems where access often matters more than capital. And through all these layers, time awareness, leverage, incentives, clarity, execution, values, and contribution, visionary wealth thinking becomes less about tactics and more about identity, a way of operating in the world that consistently favors long-term outcomes over short-term validation. And this identity shift is subtle but profound, because once someone truly sees themselves as a long-term builder rather than a short-term consumer, their decisions naturally align with growth, resilience, and adaptability, even during uncertain economic environments marked by rapid change, political noise, and market volatility. And while no strategy eliminates risk entirely, visionary thinkers accept uncertainty as the price of progress, choosing preparation over prediction and discipline over drama, knowing that wealth is not built by reacting to every swing of the market or economy, but by staying anchored to a clear vision while adjusting tactics as conditions evolve. And this adaptability, grounded in principles rather than rigid plans, allows them to navigate complexity with confidence, steadily transforming intention into outcome over years, not months, and reinforcing the reality that visionary wealth is not a secret formula, but a sustained way of thinking, acting, and positioning oneself ahead of where the world is going rather than behind where it has been. And within this way of operating, visionary wealth thinkers also develop a deep respect for compounding not just in money, but in habits, relationships, and reputation, understanding that small behaviors repeated daily shape financial outcomes far more than occasional bursts of effort, which is why they are intentional about routines that support clarity, learning, and execution, even when those routines feel unglamorous or slow, because they know momentum is built quietly before it becomes visible. And this quiet phase is where most people quit, misinterpreting lack of immediate results as failure rather than incubation, while visionary thinkers expect this delay and use it to their advantage, strengthening foundations while others lose patience. And this expectation gap becomes a powerful edge in markets, careers, and entrepreneurship alike, particularly in the U.S. environment where speed is celebrated and patience is often mistaken for hesitation. Yet history consistently shows that durable wealth is created by those willing to endure boredom, volatility, and uncertainty longer than the crowd. And this endurance is supported by a clear understanding of probability rather than certainty, because visionary thinkers think in ranges and scenarios instead of fixed outcomes, asking not what must happen, but what could happen and how exposed they are to each possibility, which leads to smarter risk management, broader diversification, and fewer catastrophic mistakes, especially in times when leverage is easily available and optimism runs high, and they are acutely aware that the biggest financial setbacks often occur during periods of apparent stability rather than obvious crisis. When complacency replaces discipline and assumptions go unchallenged, so they regularly stress, test their financial lives by asking uncomfortable questions about dependency, fragility, and downside exposure, not out of pessimism but out of responsibility, because protecting what you have is just as important as growing it. And this protective mindset becomes increasingly critical as wealth accumulates, since larger portfolios amplify both gains and mistakes. And visionary thinkers prepare for this by building teams, seeking diverse perspectives, and resisting the temptation to believe their own narratives too strongly, recognizing that humility is a financial asset in a complex world. And this humility also shapes how they view success stories, avoiding blind imitation, and instead focusing on principles that can be adapted to their own context, understanding that copying tactics without understanding conditions often leads to disappointment, while internalizing frameworks allows flexibility across changing environments. And this adaptability is especially valuable as technological change accelerates and traditional career paths become less predictable, making it essential to think like an owner, even when working within organizations, constantly building transferable skills, social capital, and optional income streams that reduce dependence on any single system. Because visionary thinkers know that concentration of risk is often invisible until it's too late. And redundancy, while seemingly inefficient, is actually a form of insurance against disruption. And this belief extends to personal finance, where maintaining multiple income sources, diversified investments, and adaptable skill sets creates resilience that cannot be replicated by a single high-paying job alone, no matter how secure it appears. And as this resilience grows, visionary thinkers gain the emotional capacity to make counter-cyclical decisions, investing when sentiment is low, negotiating when leverage shifts, and moving decisively when opportunities align with long-term vision, rather than hesitating due to fear or overconfidence. And this emotional steadiness is perhaps one of the most underappreciated components of wealth, because financial markets and business environments constantly test psychology more than intelligence, rewarding those who can remain rational under pressure. And this rationality is cultivated through preparation, reflection, and a clear understanding of personal risk tolerance, not the theoretical risk tolerance people claim to have during calm periods, but the practical tolerance revealed during drawdowns and setbacks, which is why visionary thinkers regularly review past decisions to understand how they actually responded to stress, using that insight to adjust strategies before the next challenge arises. And over time, this creates a personalized approach to wealth that fits not just market conditions, but human reality, reducing the likelihood of abandoning sound plans during difficult periods. And as plans are followed consistently, trust in the process increases, further reinforcing discipline and confidence, creating a virtuous cycle where good behavior supports good outcomes and vice versa. And this cycle is strengthened by a long-term orientation that reframes setbacks as data rather than defeat, viewing losses as tuition rather than tragedy, provided they are sized appropriately and learned from, which is why visionary thinkers emphasize position sizing and downside control as much as upside potential, knowing that survival is the first requirement of compounding, and that avoiding ruin matters more than maximizing returns in any single year, especially in a financial landscape where narratives shift quickly and extreme outcomes are increasingly common. And this survival mindset also encourages flexibility and identity, allowing people to evolve as conditions change rather than clinging to outdated self-concepts tied to specific roles, industries, or strategies, because visionary wealth thinking recognizes that adaptability is itself a form of capital, one that grows in value as uncertainty increases and as individuals become more adaptable. They also become more discerning about where they place attention, energy, and capital, increasingly saying no to distractions, mediocre opportunities, and short-term temptations that do not align with long-term vision, which creates space for deeper focus and higher quality decisions. And this focus compounds into mastery over time, whether in investing, business building, or strategic leadership, further widening the gap between those who react and those who intentionally design their financial lives. And through this ongoing process of learning, refining, and aligning, visionary wealth thinking becomes less about chasing wealth itself and more about building a system that naturally produces it as a byproduct of disciplined thinking, intentional action, and long-term alignment with where the world is heading rather than where it has already been. The true message of visionary wealth thinking is this: your financial future is not determined by luck, timing, or talent alone, but by the quality of your thinking and the consistency of your decisions over time, because wealth is built long before it shows up in numbers. It begins when you choose long-term vision over short-term comfort, discipline over emotion, and preparation over prediction. And in a world that rewards speed, noise, and instant gratification, the real advantage belongs to those who can slow down, think clearly, and act deliberately, understanding that every dollar, every hour, and every decision is a vote for the future you are building. So if you want a different financial outcome, you must first adopt a different financial identity, one that prioritizes ownership over consumption, resilience over appearance, and legacy over lifestyle, because markets will rise and fall, technologies will change, and economies will cycle. But those who think in systems, protect downside, and stay aligned with long-term progress will continue to move forward regardless of conditions. And this is your moment to stop reacting to the world as it is and start positioning for the world as it's becoming. To commit to learning, to commit to patience, and to commit to action. Because visionary wealth is not reserved for a select few. It is available to anyone willing to think ahead, stay disciplined, and take responsibility for their financial direction. And if this message added value to your thinking, make sure you subscribe for more conversations about building real, lasting wealth, and leave a comment below sharing one decision you will make differently starting today, because the future will reward those who prepare for it now.